We'll be going over Schedule A of your Form 1040. This covers itemized deductions that you may use to reduce your taxable income on your federal income tax return. So most taxpayers should be aware that the federal government allows you to take either a standard deduction or itemized deductions based on certain expenses that you incurred during the tax year. So if you're completing Schedule A, the first thing that you should do is determine whether or not the standard deduction is greater than your itemized deductions. Generally speaking, for most tax situations, a taxpayer would take the higher of the two deductions, but there may be certain instances where you would claim itemized deductions even if they are less than the standard deduction. So what we'll do is we'll go through this Schedule A. This is for the 2024 tax year. For taxpayers that are still working on prior year schedules, this isn't a whole lot different. And if you need specific details on each of the categories of expenses, we do have separate videos that go into a little bit more depth on each of those. So really quickly, we'll just go through this and kind of just so that we can have a better understanding of what we're looking at. So the first thing that we have is medical and dental expenses. Then we have taxes that you paid over the course of the year, interest that you paid over the course of the year, charitable contributions, casualty and theft losses, other itemized deductions, and then finally the total itemized deductions. So let's take a start at the top. We'll complete this as if so name or names as shown on the tax return. The Social Security number would be the primary taxpayer's Social Security number. So in this case, John's name is listed first. His Social Security number is reflected here. So we're going to talk about the medical and dental expenses. So there are certain expenses that you can deduct for medical and dental payments. The general rule is that you can't deduct anything that you were either reimbursed for under, like, say, a health savings account or Archer MSA, and you can't deduct any expenses that insurance covers. So these are really out-of-pocket expenses. You can include certain expenses like insurance premiums, prescription medication, insulin, doctor appointments, examinations, x-rays, labs, certain qualified long-term care expenses, hospital care, weight loss treatments, Medicare Part D premiums actually can be included as an itemized medical expense. Certain surgeries for laser like eye surgery, things like that. Medical treatment for drug and alcohol addiction, vision, like medical aids, glasses, things of that nature. All of those can be covered. Ambulance service, cost of breast pumps and nursing supplies, personal protective equipment used to prevent coronavirus. If you use long-term care premiums as a medical expense, do be aware that there is a limitation based on age. So the premiums that you pay, there's a chart that the IRS updates every year in IRS publication 502, which is the pretty big publication that discusses medical and dental expenses. So if you're 40 or under, you're going to be taking a lower deduction than if your age is, between age 60 and 70. There are certain medical and dental payments that you can include. diet foods, cosmetic surgeries, life insurance policies, uh, drugs not approved by the FDA, non-prescription medications, except for things like insulin, uh, funeral costs, uh, actual professional nursing care for a baby that's healthy. So we break down what you can include and what you can't include a little bit more in detail in our article, which you can find on teachmepersonalfinance.com. If you type in Schedule A or IRS Schedule A, you'll see the article, the updated article appear. So let's go ahead and just include, let's just say that John and Mary Doe had $20,000 of expenses. And let's say that their line 11 amount on their Form 1040, this is the adjusted gross income. Let's just say that that was $100,000. So the reason we put the adjusted gross income in here is because we now have to multiply that adjusted gross income amount by 7.5%. So that's $7,500. And we subtract this from line 1. This gives us 12,500. So now I'm going to take a moment to recap what we just did. So with medical and dental expenses, you have to, in order to itemize them, you have to exclude anything that is below 7.5% of your adjusted gross income. So basically that's what's known as a floor, a deduction floor. So anything below that amount is not deductible, and anything above that amount is at least eligible to go on Schedule A. We would need to take a step back to see if this helps outweigh the standard deduction that you would automatically be entitled to. But so you can see how this can change based on your income. Let's say that the Doe's adjusted gross income is $200,000. That would make this amount $15,000. And then that would make this deductible, or this amount, $5,000. And then if we did, 250,000, or let's do 300,000. By the time we get to $300,000, that becomes 7.5% of that is what is that? 21. It's not 21,000. It's 22,500, which would completely eliminate this deduction. So, your adjusted gross income does impact the deductibility of your medical and dental expenses. So just kind of keep that in mind. On years where you generate a lot of taxable income or adjusted gross income, you maybe go into the standard deduction, even if you have high medical and dental expenses, even if all of these other expenses are pretty high in that given year. So just keep in mind the medical and dental expenses are subject to a floor. So the next section is taxes that you paid over the course of the year. Line 5 is state and local taxes. So what this means is in line 5A, you're going to take either state and local income tax or state and local general sales tax. On line A, you can include one or the other, but not both. You can, and there are several methods that you can use to determine whether which one you would be better off with. Now, if you live in a high tax state and you're going through items 5A, 5B, 5C, and 5D, keep in mind that you are subject to a ceiling of all of these of $10,000 per cup or per household, or $5,000 for married couples filing jointly. So if you live in a state like New York and California and you have a lot of disposable income, both of those, may lead you to a $10,000 uh, limit and above. And then in that case, you would probably pick the one that's easier for record keeping purposes. But in our article, you can actually look a little bit more detail on the ways that you can either use the actual expenses paid method or IRS authorized estimates, based on rough calculations, based on income, things of that nature. The IRS website has a couple of calculators that you can use, and you'll find further instructions on that in our article. So if you choose to use the sales tax, you would check this box. Let's just say that they're going to go ahead and use $5,000 worth of income taxes that was on their 1099s and their W-2s, and they can figure that out pretty quickly. Let's just say that real estate taxes for the year were $4,000, and then they had another $1,000 of personal property tax. You'll add this all up, and we get $10,000, which happens to be the limit. Now, you'll notice that if you made this $2,000 and this became $11,000, you would still enter the smaller of either this amount or $10,000. So by the time you get to 5E, if you have a number that's larger than $10,000, you need to go back through steps 5A and through 5D and just double check where you went wrong. As I mentioned, the IRS website, our articles, and we have YouTube channels that walk through various worksheets and calculators to help you determine, sales taxes, income taxes, which one would be better off for you. So there's a worksheet in the form instructions that would walk you through the sales tax calculation based on estimates related to your income. So line 6, you would enter other taxes that aren't subject to that $10,000 limit. You would have to list each type of tax and the amount of tax included. You can include taxes that you paid to a foreign country, like income tax. You can also include any generation skipping tax that was imposed on income distributions. However, you can't include taxes paid to a U.S. territory. You would have to go to the appropriate state and local line. So if you were paying taxes to, say, Puerto Rico, then you would end up having to put that in here somewhere. You may also, if you're paying foreign tax, you may consider taking a tax credit for the foreign taxes instead of a tax deduction. As a general rule, tax credits are preferable to tax deductions. However, everyone's tax situation is different, so you would need to kind of talk to your tax professional or find a way to compare apples to apples here. But if you did do that, you would use Schedule 3, line 1 to report your foreign tax credit, which you would calculate on IRS Form 1116. So let's just say that in this case, they don't have any of those taxes, so our limitation is $10,000. Now, interest that you paid, most people think of home mortgages as like, this is the interest that we paid. And certainly that's line 8 right here. There are a couple of rules that you should keep in mind. After 2017, this is when the Tax Cuts and Jobs Act took place. And there is a limit on loans that you took out on or before December 15th, 2017, which is, the date that the new law took place. So for home mortgages that were taken out before that date, you can deduct home mortgage interest on up to $1 million of mortgage debt. So if you had a home that was a $900,000 loan, you'd be able to take out the full amount of interest that you paid on that. If you had a loan that was taken out after December 15th, that limitation goes down to $750,000. And if you're married filing separately, then you would split that, and each spouse would take $500,000 or $375,000 respectively. So the other aspect to this is that you can only deduct home mortgage interest that is considered to be qualified home acquisition interest. So before the Tax Cuts and Jobs Act, you used to be able to take a home equity line of credit, and then you would just, you could pay your credit cards off, you could pay off a car balance or whatever it was. If it was reported to you on a Form 1098, you'd still be able to deduct it on your tax return. Now, you're supposed to tell the IRS whether or not you used your entire mortgage to specifically buy, build, or substantially improve your home. If you did not, you're supposed to check this box here, and then there would be further instructions based on loan proceeds that were not used. And you're supposed to only use qualifying debt. Again, that's home mortgage or loan amounts that were used to buy, build, or substantially improve the home that's securing your loan. So a lot of people used to do things like take out a home equity line of credit to go buy a second property and then deduct all the interest. It's not as straightforward in today's world as it used to be. If you took out a home equity line and then used it to do kitchen renovations, that would be a completely different tax treatment than if you took that home equity line to pay off credit card debt. So in line 8A, we're going to enter the amount of home mortgage interest and points that were reported to you on a Form 1098. Let's just say that they paid $5,000. In line 8B, you're going to report anything that wasn't reported on a Form 1098. So if you paid interest to a recipient that didn't give you a 1098, you'd report your deductible home mortgage here instead. So like seller financing is probably the most common type of mortgage interest that would fall into that. There's a space provided where you would need to indicate the person's name, their tax ID number, and then their address. If the recipient is an individual, it's their tax ID number is their social security number. Otherwise, it's the employer identification number. The other thing is that you also have to let the recipient know your social security number, or else you're subject to a penalty because they have to report that as income on their tax return, and they would need your social security number. And this allows the IRS to cross-reference the two tax returns to make sure that you're on the same page. And then line 8C is points that weren't reported to you. So if you paid points only to borrow money, they're deductible over the life of the loan. Even if you refinanced, you would still have to pay those points over the life of the loan. If you use part of the proceeds to improve your main home, you may be able to deduct part of those points in the year that was paid, but you would need to go into further detail to figure that out. Line 8D is reserved for future use. So we're going to combine all of these, which we only have an amount reported in line 8A, and that's going to be $5,000. In line 9, we're going to talk, this is investment interest. So if you used investment interest, if you borrowed money to buy property that was held for investment, this could be margin interest. This could be interest on a second or like a rental property. It does not need to include any interest that's allocated to passive activities or to securities that generate tax-exempt income. So if you bought municipal bonds on margin, you would not be able to include that interest here. And to be honest, if you use this money to buy like a rental property, you might be better off reporting that on Schedule E as supplemental income instead of this. You would need to complete and attach IRS Form 4952 to calculate your interest expense deduction, but you don't necessarily need to if your expense if you meet certain criteria. So we'll put that in. You can figure out that criteria in the article. But let's just say that they had $1,000 of interest that was on margin. So now we've got $6,000 of total interest that was paid that could be itemized in Schedule A. Charitable deductions. So we've got 3 lines. Line 11 is for gifts that you made by cash or check. If you made a gift of $250 or more, then you need to have basically what's known as a contemporaneous written acknowledgement from the charitable organization. Basically a receipt that says, that you gave them the dollar amount. Like you can't just, if you put $20 in a tithing bowl for your church and you wanted to claim that, you can just write that in there. If you put $300 in there, you would need to get a receipt from the church. So basically that's what that's saying. So let's just say that the Does reported $1,000 by cash or check. They have documentation. They can show that over the course of the year, if they contributed $20 a week for 50 weeks at their church, they wouldn't have to have any additional documentation. But if you made a single gift of $250 or more, then you would need to have that contemporaneous written acknowledgement. You can also, for cash or check, you can also use documentation. If you have actual canceled checks, you could use that. There may be limitations that apply to charitable deductions. So pay attention to those details. We do cover that a little bit more in our article. In line 12, these are contributions that were made by other than cash or check. So if you made a gift of $250 or more, you would need a written, contemporaneous written acknowledgement. If your deduction is $500 or more, you would need to attach a copy of IRS Form 8283. That's non-cash charitable contributions. If you had donated a vehicle, then you should receive a Form 1098-C to acknowledge that is the substitute for the contemporaneous written acknowledgement. And if you have a donation of $5,000 or more, then you may need to attach an appraisal to your tax return. So that would all be covered under IRS Form 8283. So we're going to say that we have nothing here. In line 13, these would be carryovers from prior years. So if you aren't allowed to take a charitable deduction in the current year, if you over contributed and your total charitable contribution was limited by the adjusted gross income amounts, you can carry them forward for up to 5 years. For example, carryover amounts from contributions made in 2020 or 2021 are subject to a 60% limitation if you deduct them for the 2024 year. So you may have been waiting up until this time to be able to deduct that. So let's just say that they had $1,000 of carryover, and that means that they have $2,000 total of charitable deductions. IRS Form 4684 covers casualty and theft losses. We've gone into that in a little bit more detail offline or in a separate video in an article. But if you do use IRS Form 4684 to calculate the amount of deduction, you would enter the line 18 amount of that form. So let's just say that that's $2,000. And then line 16 contains other itemized deductions. So this could be, according to the form instructions, this could be gambling losses, only to the extent of gambling winnings that you report on Schedule 1. So if you don't win any gambling money or you don't report any gambling income, then you can't take any gambling losses. But let's say that you won $5,000 and you know you at least spent $10,000, then you would report the $5,000 of income. You would, if you itemize your returns, you would be able to include $5,000 as a deduction, and that's the way you would net out the income from the gambling. Casualty and theft losses from income producing property, estate tax on income in respect of a decedent, certain other kind of rarely reported itemized deductions. You can report those here. There are a slew of miscellaneous itemized deductions that are not available through the 2025 tax season. So under current law, unless a new law is passed to change or restore those deductions, then starting in 2026, you're going to see a lot of new itemized deductions that were previously allowed come back onto Schedule A. And then in line 17, we're going to add all of these items. So we've got 12,500 plus 10,000. So that's 22,500, 28,500. Let's call this 32,500. And then if you decide that you're going to itemize deductions, even though that there are less than your standard deduction, you may do this for state tax purposes or other purposes. You would check this box right here. So, in John and Mary Doe's case, you would then take a look at the 32,500, compare that to the standard deduction for 2024, which is less than that, and it would make sense that you would go ahead and take the itemized schedule on Schedule A, again, unless there's a tax benefit to itemizing for state tax purposes. So that's all we have for this video. We'll put relevant links in the show notes to other forms and the playlist of our videos that we have where we break down each of these expenses in a little bit more detail. So, and then we cover all of the 2024 updates in our updated article, which you can find on Teach Me Personal Finance. So if you just go to teachmepersonalfinance.com, type in Schedule A, you'll see the updated article there. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.